back in San Francisco. Dylan Radigan in Midtown Milan, here to join you for the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, Tasty Trade on the website, tastylive.com. Come over to YouTube. Tell us what you're trading today. What do you think of this market action? A little midday dip for stocks was no problem because we closed the session here on the highs. The S&P 500, 64.91, a new all-time closing high here for the stock market on this Wednesday, breaking through the highs that we saw at the end of July. Likewise, the NASDAQ, which spent a good chunk of the day in the red, finishes higher, up by 0.03%. It's a new all-time high. And the Russell's rip post-CPI, that continues up to a fresh yearly high here. There's lots of risk taking in today's market. Silver's bouncing 1.5%. Bitcoin's up over 2%. Ethereum up 4%, approaching $5,000. Wow. Risk is on. Dylan, our star of the supernova. How you feeling today?
A little, the problem is I think I didn't sleep well or something because I spent a bunch of time thinking today.
Oh, God.
Yeah, it was a disaster. So, so I didn't do anything, but at least I have the things that I had on, and it's ultimately more good than bad. But it just seems wacky, the whole thing. But anyway, I think it's the lack of sleep. So my conviction level is actually diminished, but I wouldn't overinterpret that as anything other than sort of the risks of thought.
See, this morning I did the opposite. I woke up, I got an IV, vitamin B, taurine, magnesium, Toradol, Zofran.
Potassium in there too. If you're gonna
don't worry.
Creatine?
I got that shot that makes it taste like Flintstones in your mouth. I'm ready to run through a wall. What rib pain? There's no more of that. And that was, and I said, I'm feeling pretty good today after I came home. Time to buy more stocks, Mr. Radigan.
Look at you.
So I'm back in. I'm looking out now on the longer term basis, 48 days. Little thing, just dipping our toes in. Finocchio wants to wet his beak here a little bit. It's a Godfather reference. Long the 6,700, short 6,750. It was fun, Ilya. No, it wasn't. Being a bear.
No, it wasn't.
For the past 2 weeks. Or even directionally neutral. But the breakout in stocks is at least there. We were talking about this yesterday on the show. If we see the further progress, it looks like there could be rotation afoot. Maybe that gives the S&P 500, the Russell, more room to run. And sure enough, they are leading our NASDAQ here today.
Yeah.
So, Ilya, I think you have declared this poking of the bear finished.
Yeah, you have to trade with the price action. This is where you have to remember that all of your thinking, if you so choose to engage, does not mean anything if the price action isn't complying. And so, in so much as we had a break of the high on the S&P today, you had a break of the high on the NASDAQ today, or yesterday, you had a break of it on the Russell today. I'm not fighting that. No, thank you. And this is why I poke the bear with cheap vol risk-defined verticals. Across all three indexes, I ended up giving away less than 1% of equity on each attempt. This is why I do it that way. This is why I build tons of duration into these things to dilute exposure to delta. This is why I use ETFs and not the futures, to keep things small, to keep risks contained, because there's always time to scale up if the price action goes your way. Price action didn't go that way here, clearly, so I'm out. Okay, we'll try again when it seems like there's an opportunity. But the risk-reward has been reset here. I don't think it looks awesome in either NASDAQ or the S&P, but it looks solid in Russell.
Dylan, this stock enthusiasm was across the board here today. I even saw a company by the name of Bullish have its IPO.
Actually, I visited the New York Stock Exchange today from Milan, interestingly enough, and noticed the banner on the building, using my teleporter, of course.
Well, naturally. The company IPO'd on Wednesday in a range of $32 to $33, which valued the company at $5.4 billion when it opened, putting it right now, given current prices, it has a $13.2 billion debut, now at $70.91. Not too shabby, Mr. Radigan, but it's a crypto company that's surging here out of the gates on a day when we have crypto pummeling the market, moving up to new highs. I see this as a new high close in the BTC futures contract. I see this as a new high close in the Ethereum contract right now. Mm-hmm. Is this a macro story, Dylan? Are you looking at the money leaking into the world of crypto? And is this something bigger in the state of play that maybe we're not paying attention to?
Boy, I mean, so I guess I'll focus on what I feel like I know and sort of avoid what I don't know. The biggest thing that we know, and I think you hit on this the other day, and I think we sort of probably haven't hit on it enough recently. We hit on it a good bit a few weeks ago. The Trump tax legislation is so beneficial to the rich, and it so encourages the flow of money into assets, because people who already have a lot of money, when they get more money, don't necessarily buy more things. They just park the money in financial assets or real estate or art or whatever it is. And so I do kind of wonder to the degree to which that is a factor in all of this. You know, even in the sort of the ebullience of the supernova, is it entirely driven by AI? Probably not, right? It's probably driven by macro factors about the flow of just the availability of cash money. And so I think that that's a meaningful consideration. I do, Ethereum, why would Ethereum suddenly break out? Who the hell knows, man? Why didn't Ethereum do anything for the last couple of years? You could make a case that, well, now because you have the crypto president, that it's all crypto positive, but why now? I don't know. Is it an indication of negative dollar sentiment? I don't know if it is even. I do think that when it comes to the idea of not thinking and instead, buying assets, that buying an asset that is crypto should be on the buy sheet. It shouldn't just be, Meta, Nvidia, and Microsoft. Even though when I think about crypto, I have to really ask questions.
I mean, I think when you look at sort of money chasing assets here, you get to a conversation, especially on a day like today, where you have a further winding up of Fed rate cut expectations. The markets are now starting to lean in. Maybe the Fed will do more than 2 cuts this year. I mean, the bonds rally today pretty significantly, and you get this sense that the market has just fully embraced this kind of a risk-on perspective, saying, oh, well, the money's going to be cheap, allocate accordingly. And so you see it across the board today. If we look at what the markets are baking in now for Fed stimulus, it's 125 basis points between this year and next, and this year has gone out to 58 basis points. That's the most dovish it's been all month this month. And if you look at next year, you're at 68 basis points, which is way more than what the Fed has. And the cumulative 125, I mean, we're talking 5 rate cuts to the Fed's 3, and that's the most dovish we've been since basically NFP. So we're in a place here, seemingly, where money is perceived like it's going to be cheap, and the economy hasn't in some sort of an unequivocally obvious way fallen apart. So money is just pouring into risk. The dollar's a little bit lower today. You're kind of seeing it across the board. And it looks like Chris is having some.
We lose Chris?
I think so. I think so. I can still see his charts, though.
What I'll get at, because all of this, even though I know I've been the champion of not thinking, man, it seems like if there was ever a time to consider a little short nibbling, just on the price momentum. I mean, I guess I'm I'm totally contradicting myself, and I'm sure it's because I didn't get a good enough sleep. But I just feel like the sort of uncorking today on that we're going to get all the things that you just talked about, Ilya. Like, if I wanted a short nibble, where would you put me? I guess it'd be my question.
This is, I think, one of those times, and this is why I sort of cleaned house today. This is one of those times where, for me, I need to see a price action signal. When I saw the price action signal at the end of July, showing the market is shrugging off good news, it's embracing bad news, it's starting to roll over, you go, okay, the price action is whispering things here. Let's take a shot. Let's see. Vol is cheap. Yes, yes, no, no. And I just don't see the price signal here. So I think rather than saying, okay, I'm going to bet that equities are wrong, you might instead look and say, well, I'm going to bet that the bond market is right. And say, okay, well, either the equity market is right or it's wrong, and it can, as we know, remain irrational longer than we can stay solvent. So you have to be careful.
Thus, my whole thinking issue. But yes,
right.
So then, how do you square today's bond market action then? Because I will tell you, today was a difficult day for me in my mental model of how I'm viewing the market. Right. I think yesterday was a big regime shift with the way small caps performed. We're going back into reflation. Fine.
Maybe.
How are bonds are going back up though today? Gold's not benefiting.
I think that's what it is. I mean, look at the Fed funds futures pricing, look at the bonds. I think what we're seeing today is optimism about the cheap money is coming to save us all. And whether that's
meaning that the CPI, was a green light for rate.
Meaning the CPI was a green light.
Well,
meaning the CPI was a green light.
CPI being a green light or not, we've now had how many months where we've been running above the Fed's target, Elia? 67?
Oh, I'm not suggesting that the markets are right to think that we have a green light.
But if the green light being, let's say we're getting the Fed cuts, what does that mean for asset prices? Yeah, they're going to let inflation go up more. But Dylan, effectively, the market is now repricing a Fed's inflation target from 2% to basically 3%. Like if the Fed is going to be conducting looser monetary policy in a world where, if you look to the Atlanta Fed's inflation dashboard, every single metric is flashing red. But the economy is not slowing down. So if you're projecting cash flows and equity valuations expecting 2 to 2.5% inflation in perpetuity, what does your growth rate look like if you're going at a 3% run rate? So we're going to get looser policy, but Dylan, this is certainly not a thinking question. If the Fed's inflation target is 3%, is that materially different than a 2% target for businesses? And if it's not, are equity markets undervalued? It's a stupid question. It's a stupid question.
I think it's the right question. Go ahead, Ilya. Sorry.
The market has been saying for months, right, that inflation is not an issue. And it's not because they don't see the tariffs being inflationary, because that would be silly. What we are instead seeing is the market saying the tariffs are going to be such a hit to growth that part of it will be more disinflationary on growth grounds than the upside shock is. And the Fed, because it takes a single rate cut anywhere from 12 to 18 months, typically, to work its way into the economy, the Fed needs to get in front of this thing. Because if we look at the break-even rates in markets, they've not really recovered since April. They've been in a choppy range. But whereas stocks have rallied, inflation expectations, market-based, haven't really gone anywhere. They've stopped falling, but they're, for the most part, anchored in a kind of sideways band.
Mm-hmm.
And so the market is telling the Fed, yeah, inflation measures might be high now, but you don't need to worry about anchoring inflation expectations. This is not going to spit out on you. You can start to pave the runway because we're going to need it, because otherwise you're going to miss the window.
Mm-hmm.
And the markets, for their part, are now convinced there is a 0% probability in Fed funds futures that there is no cut in September now. 0. It's 94% almost of a single cut and a slight sprinkling, a soupçon, if you will, of a probability that you get 50 basis points in September. The markets are sort of fully running head first into, we are going to get easing, and it's going to be wonderful and glorious, and it will paper over all of our sins.
Thus, the no-thinking supernova thesis gets stronger, not weaker, in the face of the CPI green light, which oddly then caused me to think.
Yeah, so, and the thing is, you would be forgiven for thinking, because when you look at what the CPI number was, you saw tariff-based inflation in it. It's leaching slowly because obviously the first quarter, everybody ramped up inventories, and so you haven't seen the full inflation increase in prices yet. Mm-hmm. You're seeing in the PPI data, and we'll see more when they're updated tomorrow, but for 3 months now, you've seen that intermediate level inflation is getting bogged down because businesses are taking it into margins and not passing it on, even to more final wholesalers, never mind to consumers. Mm-hmm. It's just slowly starting to leach. So, of course, the inflation numbers are going to get higher because they can only take it on the chin for so long. I think from the market's perspective, what they're saying is, yeah, but when all of this hits, it is going to be such a growth nightmare that you should be getting ahead of it now. Mm-hmm. I think the real question, I mean, obviously we have Jackson Hole coming up next week. If we get a Powell speech where he's like, yeah, maybe we're going to have to be slow, maybe we don't see an urgency, the markets are all kinds of up in arms, but we don't know really what that's all about. If Powell doesn't reinforce all of this, if he doesn't stamp it, that's going to become an issue going into September. If all of a sudden the markets find that all of this dovishness is wrong,
catastrophic. I mean, this thing, that's why I'm saying I got sort of sucked into some thinking, which was, you know, especially with the upswing and the green light, like it just feels really, really perfectly, you know, the cliche of price for perfection seems very sort of apropos. I don't know if it's a soupçon, but I do believe it is apropos.
Well, and quite right. And the moment that this market shows a sign of weakness, like if the S&P, let's say, dips back below its July, like late July going into August high, if this breakout fails, I'm right back short. Mm-hmm. That would be a tremendous signal here. I mean, stock markets love to squeeze sellers out. So perhaps Perhaps this was the last kind of smack on the chin, and then it turns once everybody has experienced maximum disappointment from all sides. But the price action will say that. It will show us.
I mean, do you understand my thought, Chris? We've lost him once again.
Yeah, it
just feels too good. And then I'm all in favor of the goodness. But this just was ridiculously good.
Yeah, I mean, you get to a point, and I'm going to talk about this on Macro Money today, but you get to a point where you have to start asking questions about economic growth and whether gravity exists. And there seems to be this kind of cognitive dissonance between the markets going, oh, goody, rate cuts, and stopping short of saying, why do we want this so bad?
Mm-hmm.
Why do we need all this easing?
Mm-hmm.
Why is the Fed saying, hey, listen, the economy is fine? And the market goes, no, it's not fine. You better give us 3 cuts next year. And the Fed goes, how about 1? And the market goes, 3. But why? Why is it that they want them so bad? Is it because everything is great? Then why do we need the cuts? So it feels
exactly.
it feels like we're watching Wile E. Coyote run before there's the realization that ground has ended.
And I just worry whether I'm thinking.
Right. And this is why I won't go long here, but I'm also not willing to stand in front of this level of momentum and go, oh yeah, I'll be right eventually.
Mm-hmm.
No, I have money at risk. I'm not just going to lose money for no reason.
Mm-hmm.
I'll back up. It's fine.
The interesting thing
will present itself.
But I've had a good month not thinking.
I mean,
the truth.
Not thinking is not a bad thing. I think the key is not, I think, it's not to think or not think. It's to let the price action think.
Mm-hmm.
Like we can have 5, 6 versions.
But I just feel like
a possible world in our head.
Again, not to go all thought-based, but I just feel like this is a classic sell the news. Like you have all the supernova jibber jabber from me and everybody else.
Sure.
Now you have the inflation green light. You're basically now considered a guaranteed rate cut next month. The market spikes. Like if like this is for me in a thinking man's world, this is a classic sell the news.
Yes. And as ever, right? And this is sort of the cross that all of us that like to think about macro things have to bear. Macro tells you absolutely nothing about timing.
Mm-hmm.
Like you can, and I do this exercise where you picture the world in multiple versions. And you go, okay, well, if the mix of assets is, dollar is doing this, and while stocks are doing that, and gold is doing that, and yields are doing that, and oil is doing this. Okay, that's a world like this. And then there's a world like that, and a world like that, and a world like that. And you can like one of those more than others. You can certainly think yourself into one of them. But I think you have to be very, very focused on risk management and on what the price action says, because as ever, if you're right at the wrong time, you're wrong and you're going to lose money. And at the end of the day, I would much rather make money than be right.
Mm-hmm.
So I'm going to back up, but not lose my conviction.
How does the dollar shake out in a world where rate cuts are happening, but the dollar's already on its ass?
I think that's one of the most interesting things on the board here, is that the dollar is quietly attempting to bottom.
That's what that's what I was kind of what I was getting at, where it's like, okay, the dollar actually looks kind of okay in the context of a narrative that could say that the dollar might not be that okay, but it seems like it's behaving okay in the face of not okayness.
Yes, like it could have been much weaker this week for everything that's coming together and all the hope and yearning for these rate cuts.
Mm-hmm.
The dollar might have taken a much bigger beating than it actually took.
Exactly.
Like it's down a little, but it still looks like,
especially when you got the bond move like it is in the CPI green light, I could make a weaker dollar argument quickly and robustly.
Yes. And I think if your argument was we're going to have a stronger dollar because rates aren't going to go down, I think that argument increasingly flimsy.
Mm-hmm.
Because obviously we're going to get these rate cuts.
Mm-hmm.
I think the larger issue is now that we're on the other side of the April scare and we've sort of gotten past the point where, and I think stock markets speak to this, where we thought for a while there that we were going to recklessly crash the entire dollar-based financial order.
Mm-hmm.
And then the bond market got quote unquote yippy. And the administration understood that, like, listen, there's policy we can debate, and then there is self-harm. Stop the self-harm.
Mm-hmm.
And they did. And they did. And I think when that occurred, and whoever is in there explained that, listen, you can do all kinds of things, but if you don't have this dollar recycling into our markets to keep interest rates in check and keep the government financed, then all of your great ideas are worthless, as is everybody's idea. Right, left, whatever. It doesn't matter. You can't run this thing if you break the dollar, because then you destroy the U.S.'s ability to finance debts cheaply. You essentially opt to say, we could have borrowed with impunity for very little money, and we're going to purposefully not. I think they learned that that's a stupid thing.
Mm-hmm.
And so now that we've learned that, the dollar can reclaim its haven role. So if there is some sort of a shakeout, I think we go back to dollar liquidity, much like we did in 2008 when everybody was all, wait a minute, the crisis is in the US. Why is the dollar rallying? Because it's not rallying for any kind of growthy reasons. It's rallying because money has to go to cash, and it's the most liquid version of cash.
Mm-hmm.
That kind of argument starts to make increasing sense to me.
I know we started brushing up in here into the tariffs for a quick second, Ilya. I saw this, we talk about the dollar's role in the world. And I'm thinking about what happened at the start of this week with the VIG that's given.
The VIG.
This was a Washington Post report. Trump's using the tariffs to benefit corporate allies. I mean, allies, not corporate allies, isn't the lens after this news over the weekend that Trump is doing things that are good for American corporations, foreign market access. I know it's a silly theory with SMH doing what it's doing and then ultimately NVIDIA and AMD being the beneficiaries, I would suppose. They're not even strong in today's market. There's a rotation that's very healthy that occurs.
Mm-hmm.
But the administration clearly cares about the equity market. And if we're going to be running deficits, I think about the Mundell-Fleming model. What happens to asset prices?
An oldie but a goodie.
What happens to asset prices with loose monetary policy and loose fiscal policy? Asset prices inflate. So I don't think we ever need to do any more thinking here about this, Dylan. And I'm so surprised. I'm shocked and disappointed in myself.
And the interesting thing is I've started thinking for the first time in weeks, and I'm now nervous because I think we're on a sell that I think it's too good now. I think the CPI situation is alarming.
The CPI situation is alarming. There's plenty of things not to like in the CPI report.
I don't mean, I mean the CPI green light, the price action. I feel like there's a complete release from any perceived risk.
CTAs are levered long. I mean, this is why I don't think the CPI report's fantastic. And I think the context window is when we look at this dashboard, we had this dashboard last year. We had this dashboard last year flashing red, and the Fed gave us 50 basis points of cuts. And the context there was we just had the SOM rule triggered, right? What is the SOM rule? Claudia Sahm, former Federal Reserve official, has this rule, as it's known, where if the unemployment rate, if the 6-month average of the unemployment rate rises, if the 3-month average of the unemployment rate rises above its lowest level over the past 12 months by more than 0.5%, then you're in a recession. So this rule comes out in 2021. You backtest it through history. It has a perfect track record. So when it flashes last summer, the market goes, oh, it doesn't matter that inflation's too high. The labor market's cracking. The Fed's got to cut and they're behind the curve. But the Fed wasn't behind the curve. And the labor market stayed strong. And so their cuts gave us reflation. Asset prices go up. Gold, Bitcoin, stocks, bond yields are higher. I would point out that if you had the same labor force participation rate right now that you did at the start of this year, the unemployment rate would be closer to 4.9%. And that decline in the labor force participation rate probably has to do with Trump's deportation policy.
Probably. So
thinking about the context then, these numbers are mostly lower than what you see in the left side column here from last year. A 4.9% unemployment rate, jobs growth that's probably at a break-even rate near 70K, 90K now, speaks to a Fed that is probably going to cut and probably gives us reflation again. I mean, it really does feel like we are running back last year's Fed policy decision-making at all the same exact way. This time we didn't have a big crash at the start of August. Am I wrong for thinking that as an anchoring point, Ilya?
No, I don't think so. I mean, I think you look at sort of to both Dylan's point and yours. You look at this thing and you go, that CPI report that everybody has so embraced over the past 24 hours was at least mixed. Like, okay, fine. It wasn't outright awful, although you can very easily look and see from June to July how you have the erosion of the defenses keeping inflation out of CPI start to show up. You have the biggest contribution from the goods side to inflation in over 2 years. Core goods inflation accelerating. Highest since June 2023, over 2 years again. You're watching it. You saw in the second quarter GDP report that after in the first you had a run-up in imports and a run-up in inventories. Now inventories are coming down so much that investment is actually a detriment to growth on net. So there is no investment outside of winding down these inventories. And imports have stopped, basically. So those inventories are not getting refilled. So the insulation you had from that, from having essentially just stockpiled cheaper goods ahead of the tariffs, you're not continuing that stockpiling, even through the 90-day pause. And you're going to get PPI data tomorrow that probably tells us that businesses at the front end of the supply chain are still eating it in margin. So the defenses are weakening. And it's very like we're about to get a bunch of GDP data from other economies not called the US this week, and it's weakness expected across the board. So the US is still the only game in town. We're going to get UK, we're going to get the Eurozone, we're going to get Japan. So as you look at the landscape, it's very easy to say, well, this is why the markets want these cuts. The cognitive dissonance is when they get a little sliver of something that tells them the cuts are in, they go, oh, great, risk on. But they forget the part why they want it in the first order. And that's frothy behavior. But
There's certainly froth in the market.
But from a practical perspective, like that they jumped on the CPI and went, oh yes, everything is healed. It's like downing Vicodin for a broken arm. Like, your arm is broken. You're just choosing not to feel it right now.
Well, there is forget the business side of this. I mean, there's meaningful evidence that the consumer is slowing down.
Very meaningful, yes.
I used ChatGPT to put this together after I saw the Kava earnings. And I recall the Chipotle earnings were bad and the Sweet Green earnings were bad. And instead of just doing them by the numbers, I had ChatGPT go back in time a year. So the same store sales year-over-year growth for Kava, the Mediterranean fast casual company, 21.2, 10.8, now 2.1% growth. Chipotle, 5.4%, negative 0.4, now negative 4% year-over-year same store sales. And then for Sweet Green, fourth quarter, it was plus 4%, first quarter, minus 3.1, second quarter, now minus 7.6. Whether or not that's, Sweet Green, I use the same source sales because their margins on labor have improved. The stores in which they have implemented their infinite kitchen, basically the automated salads, we have one near us. It's like 1 or 2 employees working on those stores now. The labor savings boost the margins on a per store basis from about 23% to about 30%. But even that's not enough for the companies to see a significant decline in traffic. Is this one of those canaries in the coal mine that, in the back of your head at least, if American consumers are no longer going to fast casual, they're being priced out or they're trying to save some money, gives Ilya's point of view a little bit more credence?
I mean, I'm in a weird situation because I've been the most ridiculously bullish person on this panel for the last few weeks, and I'm flipping over today. I'm on lookout below.
So let me get this straight. I finally get on board after you chiding me for weeks, and
totally.
I get onto the ride, and you're sliding out. You're like, okay, have fun in that roller coaster.
It's terrible. I feel bad.
Yeah,
I feel like it's like
enjoy yourself.
I feel like it's some sort of cruel manipulation on my part, but for the fact that I believe you're an independent, sovereign individual who is beyond my influence. But I do believe that the AI supernova is one thing, but when you lay in this sort of absurdity of this interpretation of the CPI green light, and honestly, even slap on the Ethereum rally, which I take as evidence of another exuberant red flag, that Ethereum finally goes, that the rate cuts are a go, like that the next thing that happens is things get weaker.
It does feel very rug pullish.
Yeah.
If that's a word.
Like, I just feel like, okay, what else? What other good thing can I possibly give you?
Yeah, just the companies that make up the restaurant ETFs just don't look good. They don't look healthy. The only one that's working out here well is DoorDash. Aside from that, this is about the automated future. If the economy's falling apart, where are you going to go work? It's a depressing set of circumstances on that end, but heck, stocks are at highs. So what's there to complain about?
But
market can stay irrational as long as we can stay solvent.
Well, this is your K-shaped thesis, right?
It would be.
And It's sort of, I mean, I guess you can make an argument that, to be long the soup, that basically, I don't know.
Be long companies that cater to services for the wealthy. Yeah. I mean, so I got an interesting comment yesterday. It's like, oh, Chris, you're not sounding like your usual self. What's going on? No, I mean, I'm not trying to rationalize what the Trump administration is doing. I think all of this is incredibly stupid. What I'm trying to do is figure out ways to make money within that system of what I think is incongruent and illogical decision-making, which again, viewing it through the lens of the market is a playground for the typically wealthier. 90% of the stock market is owned by 10% of the country. 56% of Americans own equities, for what it's worth, but this is mainly for those that are well off. Who's getting the benefit from all these new laws? Who benefits the most when interest rates goes down? People can refinance their companies, right? Refinance their debt. It's the wealthy that have the ability to re-lever themselves over and over again. And just identifying that to be the system here. How do we operate within there? I mean, Uber, DoorDash, you're using those if you have a little bit of disposable income. And that's something that Raphael Bostic pointed out today. Raphael Bostic, the Atlanta Fed president, in his speech, noted very specifically, as was pointed out to me on Twitter, not only is inflation running above target, but upper income consumers are holding up. And upper income consumers are about to get a big tax cut over the next few months. When the calendar changes, SALT's back in play. Dylan, it's good for people in California, New York, Illinois.
This is a beautiful time to be rich in America.
Gilded Age 2.0, baby.
But interestingly, Porsche says their business model doesn't work because they got themselves wrapped around a tree on electric Porsches that nobody wants. So just because you're a luxury brand, or LVMH is in the tank, by the way. So it's not so linear as to say, oh, well, the companies that cater to the rich are obviously the best way to do this when LVMH is on its ass.
But those are goods.
Fair.
We're looking for service companies that cater to the wealthy. So like a private jet operator, right? That's going to be fine. But I do hear what you're saying. Like LVMUY is the LVMH Moet Hennessy ADR here in the United States. Yeah, it's been hammered this year. Absolutely hammered this year. But it's a goods, right? We're putting in these barriers for people to import things from abroad. Is that going to affect the marginal wealthy person? No, because they'll just fly there on their vacation and they'll pick it up in person. But I think that if we're going to be this is the system that we're in. We went through regime change yesterday. The Russell did not care that yields were up yesterday. It didn't care that yields were down today. The home builders, these things are ripping the past two sessions through the roof. Rate sensitive stuff. Who's going to be able to buy new homes, Dylan, at a 7% mortgage rate? It's going to be your median
cash money, baby.
Only people who are very wealthy.
Cash buyers.
So we're giving all these the wealthy top 20% of income earners in America a big tax cut, and they're going to put it into real estate and
Ethereum, apparently.
And you can't put it into New York City because if you're a real estate investor, you're going to be stuck in a rent-controlled or rent-stabilized apartment, as people in Wall Street would tell me. So you're not going to invest in existing holdings. Forget our XLRE call, Dylan. It's all about building new McMansions. How cynical do I sound?
Very.
But that doesn't make you wrong.
Well, the one thing that you missed, Chris, that we kind of went partially into it, but I think it's worth revisiting while you were experiencing your wireless fidelity connection issues, was the relative apparent strength of the U.S. dollar in a world that could argue for its relative weakness.
Yeah.
That maybe the dollar is ready for that the bottom is in the U.S. dollar, I guess is what we're getting at. Although I'm happy to talk about oil too if you want to flip oil charts at me. I always love a good oil conversation. It's one of my favorites.
The dollar's bothering me here, Elliot.
What's that?
The dollar just bothers me so much here right now.
Bothers you?
It's not, how should I say this?
Like a sore knee?
Like it should be doing a little bit better. Yesterday, yields were up, the dollar was down. Today, yields are down, the dollar is down. That's not that narrative elasticity, narrative flexibility.
I think it kind of is, actually, because I think it's telling us that well, sort of, kind of. It's telling us the dollar doesn't care about yields. But the dollar not caring about yields is actually good for the dollar because yields are going down. That the dollar isn't cratering here. That we don't have the kind of a breakout in the euro, in the pound, especially the yen, that you don't have a breakout in the yen in an environment where the whole hopium story in stocks is a oh goody rate cuts story in the wake of CPI, that the dollar isn't getting absolutely bulldozed over here and still has the bottoms in July and isn't even trying to test them. That's interesting.
That's what I was getting at.
That's interesting. And it's tempting to say that the reason why it's holding up as well as it is because we haven't really seen the shuffle in policy expectations change very much on net. So let's take the April low for the policy outlook this year and next. At that point, that was like Liberation Day, maximum holy moly. We were looking at 137 basis points in rate cuts this year and next. And most of it was for this year because the market was all frothed up thinking the world is over. Since then, we've come back to about 50 basis points for this year and more for next year. But the sum total is 125 basis points. So we've gone here and there, but we're not building more easing in the kind of way that the dollar would hate. And tellingly enough, the dollar bottoms basically July 1st and has not retested those lows, even as we get more easing in relative terms on the board. So easing wise, we've gone from as little as 80 basis points this year and next in mid-May. Since then, we've gone nowhere but more dovish. We're at 125 basis points now. Even if you take the move from mid-July, where we had 100 basis points, now we've added an extra cut. In that adding of an extra cut, the dollar has not sold off. It's actually found something of a floor. That tells me it's probably done, because it really should be falling if rates were the guiding light.
That rally at the end of July just has not seen much of a bounce yet. But if there's a place for the dollar to find a low right around 97, 98 and a half, right, this area down here.
Defend it right here.
This is kind of where we've seen the previous bounces in April and again in June try to take place, maybe a little bit lower into 97, but there's a band down here. I will point out that the two places that I've been operating in the yen and the Canadian dollar, they haven't really turned the corner yet. So I haven't been feeling this pain of the dollar fall off.
Me neither.
Dollar CAD, for example, I'm still short the call spreads up against this effectively 1 month moving average. We're in at the CZ5, 73.5, 74, this 51 DTE. It was put on when the IVRs were in the 50s. So as long as we just hang out and or drift lower, we're cool.
Mm-hmm.
So, I mean, that's kind of where, if I'm thinking about a dollar rebound, where would I want to play it right now? I'd want to play it on the currencies that aren't succeeding,
yes,
versus the greenback at the current moment during the dollar's brief period of pullback. So the yen,
Canadian dollar, Swiss franc.
Right. We had our election pull off, right? We dropped. Okay. The election results come in. We've now neutralized. Everything's fine. So we're sitting here still. I still like more yen weakness. It's an 11.6 IVR. The volatility though across the currency space, I think this is worth noting. Typically, the euro really is the only one that has significant enough trading volume if you're going to operate in the currency futures option space. Maybe the yen. You see 122,000 contracts traded here in 6E, 102 in the yen. You go elsewhere though, and it's a lot smaller. Even the pound, 49.2, Canadian dollar, 42.6. Some of these things would be better served to be looked at on the Tasty FX tab if you're on the platform. On Tasty Trade, of course, you can trade both there on the platform. now. Spot FX, Ilya, which is where you and I cut our teeth originally in the world of finance, but all of them are here with all of the crosses. Dylan, you want to hedge your trip to buy those Turkish delights? There's Euro, Turkish lira on the platform as well.
Thank God. I was going to abandon the whole system if they didn't do that.
Okay, so we do need to talk quickly about gold and silver before we go out the door. Silver has a big day today. Gold, not necessarily. Ilya, what was a little bit of an evening star candlestick cluster at the start of the week? Highlight that here. Now looks like a more of a morning stick candlestick cluster here, buttressed by that 1 month moving average. This looks like it wants to go. Gold, obviously, less the safe haven of the two, or more the safe haven of the two, less the speculative asset of the two. It's pinned at 3,400. For the life of me, I'm trying to get off an iron condor here today, 76 DTE. We're getting a 2.5 to 1. Actually, I'll just put this back on the platform right now. At 76 DTE, looking at the working order, which doesn't get filled now, it will be filled later, and we will get in. This particular trade is going to be a 62% pop, risking 2.5 to make 1. And the one that you're making is more than the buying power used. I really want this to be filled. But if we're going to think about gold, I have missed this trade a number of times. Arrogance, imprudence, not updating my worldview quick enough as things progress past April, May. 3,400 has been the Bob Barker price. The price is right here for gold at the current time. And I know it's only a 16.6 IVR, but a 2.5 to 1, 3 to 1 risk to reward in a 60 to 70% pop, you got to take that almost every time if you're going to stay mechanical.
For me, I'm sitting short vol here. I have it through calls. I've had it through puts, depending on sort of where we are in this range. The current iteration of the position is in calls, short calls, vertical, because it was done near the top of the range. And I'm perfectly happy to just sit on this for now. It's still net up. And the premium received far outweighs anywhere the P&L has gone this way or that. So I'm just going to wait here. I'm going to wait for this thing to pick a direction. I'm staying away from silver because that has all the jumpiness of what's going on now in stocks, and I don't need any part of it. I've just taken myself out of the firing line for stock market shenanigans today. I don't need to get myself back involved, especially through a higher volatility, jumpier, less liquid version of risk on. But in gold, I am perfectly happy to just sit at this point and just let the thing work for me.
All right, Dylan, take us out. You wanted to sling some oil here. What's the plan with oil? It fell back today. I'm feeling a little less optimistic about this staying neutral. If the world's so good, shouldn't oil be up?
If the rate cuts are happening, and if tariffs are happening, the non-thinking man's interpretation of that information is that it's indication of reducing economic momentum, and as such, reducing demand for fossil fuels and transportation fuel. Not to mention, tariffs specifically target a reduction in global movement of goods and services, which is the most energy intensive. So the only question with oil, I would say, is whether the decline we're looking at right now already reflects everything I've just said, or whether there's another leg down in oil as economic activity generally slows down, and specifically as multinational import-export activity slows down, which, we'll see if that even actually happens, considering how price elastic and how tolerant everybody seems to be of a higher price. But you can, the non-thinking man could make a case for at least, I guess the 22, the IV rank doesn't get you too excited, but a call spread, or some short. If I was going to do anything with oil, I'd be short. Let me put it that way.
Well, it looks like it may be breaking down, but we'll have to cover this tomorrow because overtime is out of time. For my fellow non-thinking men, Dylan Radigan and Ilya Spivak, I've been Chris Vecchio. Good luck trading. We'll catch you tomorrow, same time, same place, 4 Eastern, 3 Central, right after last call. We're coming back though in a little bit. Brief break. Tasty Live continues. Ilya Spivak with Macro Money. See you there.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Are there any names in the Mag 7 that you do not think will be there a year from now?
Tesla. Tesla's been like waiting to get booted out of the Mag 7 for years now. Like it's on it. I mean, maybe it'll make a comeback. It kind of did, but I'm not expecting it to be around much longer. I don't know.
Jeez. For the sake of argument, I'm going to say Apple.
Probably Tesla.
Ooh, toughie. No, you know what? Maybe this is a contrarian thing. I think they're still going to be there in a year.
Oh man, can't ever go against the family. They're all here to stay.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities, and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you would like the chance to share your trading journey and inspire others.
We get another push higher in the stock market as we embrace that rate cuts are apparently coming and coming for sure in the wake of that CPI report. We talked yesterday about how that report was at best mixed, but price action would not be derailed. And so we have another push higher from the stocks across the major indices today. But the question remains, why are the markets so happy with these rate cuts coming? And why do they want them in the first place? Is there some sort of cognitive dissonance between wanting support for the economy and forgetting why that support is needed? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we'll take a look at the price action today and take a look at how the markets got themselves here and what it is that they're celebrating, and then consider whether the logic makes sense and whether then from there is a trade to be had to express that view without getting run over by this incredibly buoyant momentum on Wall Street. So let's first consider how we did. And needless to say, stocks up here again today. S&P up 1.13%, NASDAQ up 0.9%, yields down across the board, as if to tell you why it is that we have this on the menu here. And as we look at this sort of in the wake of the CPI report that we saw when we looked at this yesterday, you sort of get the sense for what it is that you're looking at. Because it seems like what you have on the menu now is perfect conviction that this September rate cut is coming. And without kind of relitigating all of why the CPI report was more mixed than one-sided, there certainly is something to be said about the contribution from goods being the biggest in over 2 years. And in fact, core goods inflation being the fastest since June 2023. There is something to be said for then the Fed's concern that tariff-based inflation is creeping into the pricing structure, and that what this will do is hurt growth, which has been the Fed's song all along. Nevertheless, the markets seem to have it figured out. Not so much in that the tariffs won't be a problem, but that as long as there's rate cuts, those problems are manageable. And for all of the cross currents in that CPI data, the market has concluded in its wake that there is a 0% chance that the Fed doesn't cut rates in September. We're looking at the probabilities here from Fed funds futures, and we can see there is a 93.8, almost 94% chance that we are going to get one rate cut. Note here, the current target range is up to 450 basis points, or 4.5%. In September, we have a 94% chance that we're going to get to a range that's 400 to 425, from 425 to 50. That's one cut. And now there's about a 6% chance that actually the Fed will go bigger. So the edge case here isn't that the Fed holds, it's that the Fed cuts more. That the Fed cuts by 0.5% and not 0.25%. Moreover, if we look at the outlook for this year and next, we can see the markets are now getting to a place where they're starting to get past just 2 cuts for this year. That, of course, was where the Fed had it. Just to remind ourselves quickly, the Fed's last forecast had from 4.4 down to 3.9 median this year. That's 50 basis points. Then from 3.9 down to 3.6 next year. That's another 0.25 point cut. So that's 75 basis points between this year and next. The markets are at 5 cuts now, not 3. And this year is getting heavier. We're out to 58 basis points here. So the market is even flirting with the idea that the Fed may need to go bigger this year. That maybe just 2 cuts is not enough. Now, it's still a relatively low probability. It's only 32% chance. We've only priced in 8 out of 25 basis points in the direction of a third cut. Nevertheless, we're in a situation here, it would seem, that the market is tilting to an increasingly dovish setting. Moreover, the view for next year is, of course, unmistakably more dovish than what the Fed has on its forecasting. In this case, we very clearly have the market telling us that there is much more scope to ease than the current pricing from the Fed seems to imply. In fact, quite a bit more is something of an understatement. We're out to 68 basis points here. So the markets see at least 50 basis points, and then the probability that they are going to get that third cut out to 75, that's now starting to look like a relatively significant, better than even kind of a thing. It's 18 basis points into the direction of the cut, so a 72% chance that it's coming. And that, of course, raises a very important question. The markets are clearly happy with this development. They've clearly read the CPI numbers in a way that gives them the enthusiasm that they need to have around these rate cuts. But they seem to be speaking out of both sides of their mouth, as it were. Because if the Fed is slow, but the markets are more dovish, then the question is, well, why? Why are the markets so dovish? What is it that they're so concerned about? Why is it that we need all of these rate cuts? What is it about the current situation that, for whatever reason, seems to be telling the markets that they need to be yelling at the Fed to do more? And that's really where we take this conversation next. Because what we find here is we're going to get a nice little test of the wherewithal of the global economy here for the rest of the week. We'll get to U.S. consumption data in tomorrow's show and take ourselves back into the U.S. But in the meantime, it's the world that is going to report on these growth indications. And we can see here there's a whole slew of GDP numbers coming our way. We're going to get a first look at numbers out of the UK. As we can see here, a slowdown of significance expected here, down from 0.7 to just 0.1% quarter-on-quarter growth, so basically standstill for the UK economy. We're going to get a second look at Eurozone GDP data, where, again, we're moving in a standstill kind of direction. And then the numbers that we're expecting out of Japan, at best, hovering near that standstill level. So, needless to say, these are sort of G5 economies. So this is where global growth comes from, outside of the US and China. And these numbers clearly are pointing to some kind of a downturn. Now, the latest numbers from the S&P Global PMI data that we use to kind of approximate where we are on the global business cycle, they seem to have given us a little bit of an upturn. And perhaps that is, to some extent, encouraging until we start to look at where that upturn, at least data-wise, seems to be coming from. So we can clearly see here that basically since the beginning of last year, the trend has been lower. We hit something of a weak point extreme here toward the beginning of this year, and sort of into the end of the first quarter going into the second. And since things have kind of steadied a bit and we've come back into what is essentially the middle of this range. This is, of course, as ever, done around a center line of 50 for PMIs, where above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And these are world numbers. Now, that seems big, but of course, as we've said many times here before, world GDP really is made up of three components. It stands on three legs, of which the US is the biggest, then China, then the Eurozone are relatively equal-sized parts. That's 58% of global GDP. And the rest of world, 42%, are for the most part vendors that need the big three to be buying stuff from them in order to have demand of their own, for the most part. And so the sort of weight that demand from these three economies has in kind of determining where the global economy goes is already outsized at 58%, and in practical terms, even greater. Moreover, China is a kind of middle step economy here, where it is at the middle of the global supply chain, and again, in large part, depends on end demand in the US and the Eurozone to power their export engine. Indeed, for 9 consecutive quarters, as we've mentioned over and over here on the show, in China, we've had economy-wide deflation because there is a retrenchment from these trading partners, in particular in the wake of COVID and the reshuffling of supply chains, at the same time that there is a near total absence of domestic demand in China. And so it also is not a standalone. It also is in many ways dependent on demand that comes from elsewhere. And this then makes the situation very interesting, because when you look at the S&P Global PMI numbers, the most recent update in July, you can see that both the Eurozone and China are a hair better than standstill when it comes to economic growth. And in fact, they've been stuck in this morass basically since the middle of last year. There was an attempt at a rebound in both economies, a tepid one, going into the latter half of 2023, going into the beginning of 2024. By the middle of the year, that attempt fizzles. Then you come down and you sort of settle into hugging the neutral 50 level here for the most part. Sometimes you're a little bit under, sometimes you're a little bit over. This happens to be a part of the cycle where you're a hair above, but we can clearly see these economies are flatlining. And all the strength is in the US. So when you then look at this again and you see, well, this right here, this upswing for the global numbers, that looks very much like the same upswing as what we see right here. And that seems to suggest that as long as you believe this, then the U.S. economy is the only game in town. And as long as this persists, well then, yeah, you have global growth. But without it, not so much. And then you get to the PMI numbers from ISM that you got published last week that tell you, and those were a little bit timelier than the S&P global numbers, in the sense that the S&P global numbers were released meaningfully earlier. That survey includes more things in it from earlier in the month. You get this sense that timelier measures are already rolling over. And looking at the ISM PMI numbers here, you have services basically flatlined and manufacturing contracting. And both of them are pointing in the wrong direction for several months now. really since the beginning of the year. Moreover, if you look at the sub-components, they're not encouraging either. Employment, one part of the Fed's mandate here, is in contraction mode across the board, both services and manufacturing, both of them in the wrong way here, both of them under that 50 line. And then if you want to stick with the Fed's tariff conundrum here, weak labor markets, strong inflation, here's the inflation piece. It finally took a little bit of a dip for manufacturing in the last month's report, but we can clearly see here, inflation is very much an issue here, especially in the service sector where it continues to push to multi-year highs. We're at the highest since 2022 here. So it's not nearly so straightforward that what we saw in the numbers for the U.S. out of S&P Global is in fact the latest version of this view. As a matter of fact, it may be a little bit dated at this point, whereas the standstill here remains. And so as we look at all of these GDP numbers here, more weakness in Europe, clearly. Standstill in Japan, clearly. And really all we have to hang our hat on is the US. Just talked about China last week and how maybe there's some green shoots there, but very tepid and very early days yet. And certainly the GDP numbers are still awful. Maybe the idea that the US can continue to carry this on its back is fading away. And the one thing that cannot fail is failing. That, of course, appears in spades in US GDP data. We just got the second quarter numbers ahead of the last Fed meeting. And what we find is that, yes, there's a lot of shenanigans here with inventories and imports. In fact, to a large extent, this is how you end up with CPI data looking as normal as it has on one side of it, and we'll talk about this tomorrow, no doubt, once the PPI numbers come out. Wholesalers have been taking a hit on margins to insulate consumers from inflation costs. But on the other hand, of course, there was that first quarter front run where imports surged, inventories surged, so companies were stacked with goods at the pre-tariff cost structure. And what we already see in the second quarter is that imports have cratered. Meanwhile, inventories are already getting wound down. And if imports have cratered, then, of course, those inventories are not getting rebuilt. Importantly here, this is contribution to GDP. So imports here surging looks like it's going down because, of course, imports are subtracted from GDP. And when they rise, that's a negative contribution. When they fall, that's a positive contribution. The investment component here, which is where inventories live, when those inventories get packed in with those imports, that's a positive contribution to GDP. When those inventories get spent down, that's a negative contribution to GDP, and so the investment component comes down. So that's how you interpret these numbers. If these inventories are already falling, imports have basically stopped, well, then those inventories are not getting rebuilt. And so you're losing insulation from inflation, but you can see where that insulation has come from. But all of those shenanigans aside, consumption is the thing to look at because that's 68% of GDP. Everything else is, to a large extent, an afterthought. And between the first quarter and the second, you have the weakest 6 months of household consumption in the US since the first 6 months of 2020, which is, of course, the COVID recession. Moreover, we can see why the markets then want these rate cuts in the bond market. When in the beginning of the year, stocks and these break-even rates, which are inflation expectations backed out of the pricing of bonds, nominal versus tips or inflation-adjusted bonds, we can see that both stocks and these break-even rates fell because initially the tariffs amounted to a growth scare. Once in April, the worst of that panic went away. Stocks, we can see, have clearly had a sentiment-driven recovery, but break-even rates have not gone very far at all. In fact, even as inflation numbers have ticked up in recent months, we can see this most recent push higher for stocks, it's come with inflation expectations coming down. And in any case, since April, they've only just steadied, but largely held in a range. And so you end up in a situation then where the market is happy that there is easing coming. We can clearly see that develop here. Again, here's the S&P 500. Here is where we have this kind of April crescendo, as it were. Stocks bottom. Fed policy expectations reach a dovish extreme. We can see things then normalize. The policy outlook gets less dovish for a bit. Stocks recover. They basically reset this sell-off. And from there, it looks like the next leg higher in the stock market is largely around more easing getting priced back into the mix. Tellingly, priced into the mix without another panic, without there being some sort of, oh my God, growth scare or oh my God, tariff scare. And that likely speaks to what we're seeing right here. The markets want these rate cuts because they see growth as the bigger risk and inflation as the smaller risk. And they want the Fed to get in front of this thing. Well, if that's the case, then this three-legged stool that we're looking at, the three-legged stool that is global growth, is already 2 legs down, and perhaps this leg is already giving way, which is why the markets want these rate cuts in the first place. And it is then the price action in the US dollar that starts to become most interesting, because even as you get more and more dovish on this outlook, the US dollar having very cleanly declined as things got this dovish, seems to have attempted something of a bottoming in early July and from here. And while maybe over here in April there was a meaningful risk that perhaps the administration is going to undermine the very dollar-based architecture of the global financial system, once the panic got bad enough, they took a step back and showed the markets that they are not looking to do something quite so damaging and game-changing, which arguably is how stocks have recovered from this panic before the easing even kicked in. So this move here, this leg of it. And that, of course, takes a lot of the pressure off the dollar in a sort of structural way, and perhaps revives it as a safe haven in the event that things turn. So that the dollar is starting to find a bottom here, even as things get more dovish. That starts to tell you that Maybe the market is preparing to raise cash. Maybe it's getting ready for a big risk aversion push. You don't see it in stocks, certainly not today and certainly not this week. But you are beginning to see a bit more interest in the cash side of things, it would seem. And maybe what that means is that the markets are, as all of this easing gets onboarded into the outlook, are moved to think, well, yeah, we're happy with the easing, but why easing? Why do we want it so badly? And the thought process goes, well, if we are definitely going to get it, then are we sure it's for good reasons? And the architecture of the growth dynamic seems to say no, which is why the markets want it, but which also poses a significant gravitational risk for sentiment-buoyed stock markets. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Ragin and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Back with Chris Mondays and Fridays for Futures Power Hour, writing for the news and insights portion of tastylive.com, opining at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.thread.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, Dan Cecilia. What's up, Dan?
Nothing much. Just enjoying these markets. ETH's ripping, Bitcoin's up. I've been trading some of these treasury companies, as we talked about, so I'm happy. I hope everyone in the audience is happy as well.
Yeah, what's up? The market's up. We're going to talk about that here in just a second. I'm also curious about some of these treasury companies you've been trading, my friend, but we'll get into that. Before we do, get your ass over to YouTube, pop out the chat, and type some crazy shit into the chat, if you will. We're streaming live on Tasty Live. We're on YouTube. I think we might even be on X. We've got the Tasty Crypto newsletter pinned to the top of the chat. So do yourself a favor, click the link, get over to tastycrypto.com and sign up for the email. We send out 2 emails a week, and I've got to say, Dan, they're usually pretty good, right? Our hit rate's relatively high. Nobody's perfect in this game, but I would, I'm a little biased, but our analysis is okay.
Yeah, look, I want to just say something. I want to give myself some roses, if I may. A couple weeks ago, a couple months ago, if anybody was paying attention to the Tasty Crypto newsletter, I do a lock of the week. I haven't done it the last couple weeks. I'll get back to it.
It's summer. You get a break every now and then.
Yeah, but I made a pick for a crypto called Aerodrome.
Yes.
Ticker AERO. We don't offer it on the platform, but we do offer it in the Tasty Crypto wallet. You can swap it there.
Yep.
I think I sort of alluded to that being Coinbase's main DEX.
Yeah, on the base network.
And if you look at the price, it's gone up quite a bit. So
got to take a victory lap every now and then.
I'm taking
right?
a victory lap. Now, that's one that I got right out of thousands that I've gotten wrong. So we only pick the winners here.
Hey, every once in a while you get one right, but when we do, you're gonna hear about it. I got to give you credit. You've had a lot of great calls over the last few months, week to week. Hyperliquid, Aerodrome, a handful of others. It's a market environment where, let's be honest, it's been a little bit easier for us here recently, but I think the art is to try to stay on the right side of the trend to begin with, but also when you have everything that's somewhat positively correlated, trying to find those relative value opportunities, and that's certainly what you've done with those locks or picks of the week, and that's what we try to do in the email as well. Up until recently, it's been Bitcoin over everything. We've highlighted that and given a lot of indicators that we use to try to understand when it might be time to shift some of those positions around. And as of the last few weeks or so, you got some of those signals, and you're starting to see more of those pop up. Dan, I want to talk about a variety of things here on the show. We're going to hit on a topic that we discussed in the newsletter on Saturday, and that's the announcement that 401ks are now permitted to invest in alternative assets, aka crypto, also private equity. Some nuance to it, but we're going to break down the numbers in just a second and go around our radar, talk about some of the things we're seeing in the market. But before we do, let's do a quick market update here. And I guess I'll speak to the jet ski for a second because I want everybody to understand what the dream is here. And we're maybe, with every dollar higher in ETH or Bitcoin or any of the tokens, we're one step closer to the dream. And the dream is to just get on that jet ski and ride it off into the sunset. And that's what we think crypto offers more than anything. So, market update. Let's do that, my friend. Green on the screen. What's your favorite one? Pick one, I guess. I mean, we talked about ETH going to 5. It seems like it's on its way. I think there's probably a catch-up trade with Bitcoin at some point. Soon enough, people will pull up Solana on their screen and look to the left side of the chart and say, okay, it's now at 200. It's going to go to 250. There's some behavioral components to this. There's a few that are still underperforming, right? Solana is underperforming year to date versus Bitcoin. Doge is trash versus Bitcoin, really. But it is up 22% on the week. We can go around at some of the smaller market cap tokens. I mean, clearly Chainlink has done a little bit better here recently. We put some trades on in Aave, a handful of others. I just bought Pepe for the first time, bought 8 million of those, which is about $100. So bought some Pepe yesterday, but signals abound. Where are you at right now? What are you trading?
So I'm just holding ETH right now. I think I'm looking to begin rotating into some of these altcoins. I've talked about this on the Liz and Jenny show this past week. I made my appearance there. Jose was there. Shout out Jose. The way this market typically works is everybody kind of gets into Bitcoin. Bitcoin goes up first, right? And there's all these laggards. ETH lagged, Solana lagged, whatever. Compared to Bitcoin, we follow that Bitcoin ETH ratio. That usually goes up. People get rich in Bitcoin. What do? They usually go further out on the risk curve, so they rotate into ETH. So now ETH's going up. ETH's catching that bid. We've heard about the treasury companies, Tom Lee. It's in the mainstream, old news. So what's the next rotation? It's altcoin season. It's that altcoin season we've been waiting for. So, I think that there's some opportunities to pay attention to that rotation next.
Do you think we're seeing that now? Because I guess that's the question, right? I agree with you. That's the path. That's how this likely plays out this time. Is it now, or are we still waiting for altcoin season?
I think we're still waiting.
Okay.
But I think you have to put it on your radar now. Like, I think you have to begin sort of looking and seeing where that next narrative where that next rotation, that next flow is coming. It's hard to time it. Like, I don't know. I don't have that answer. But we're seeing some of these alternative treasury companies popping up for some of these altcoins. There's some movers there. I think Sui was up. Pepe's been up. Obviously, Solana broke 200. That's kind of been a laggard against ETH recently. So I think like that's where I'm looking. I'm looking into some of those altcoins, and it's not necessarily like Ripple, Litecoin, Bitcoin Cash, although those are probably some good areas. They're not ones I trade. I'm looking out more on chain. I'm looking at the Solanas. I'm looking at the Suis. Some of these like newer coins, I guess I would say.
Okay, let's jump over to the platform then here for a moment and take a look at some of the treasury companies, because this is providing a bid in the market, right? And I'm going to go out on a limb and say you're probably going to see more of these. Maybe that's not much of a stretch. We saw the Bitcoin ETFs. We've seen the Bitcoin treasury companies. Strategy spearheaded that effort there with Michael Saylor. You're seeing that with ETH. Presumably you see that next with Solana. Obviously it's starting. Sui, BitTensor. There's some headlines around a BitTensor acquisition company. What are the ones, for anybody that's not familiar with this, what are you trading here from a treasury company perspective that gives you some exposure? And then I guess my question is, you've got something like Solana here that's up 22% in the last week, 74% vol. Why not just trade the underlying? What's the, I guess, in your opinion, what's the reason you might look at the treasury company, or is it just you've got money in this account and it's there, let's do it?
Well, I can give specific tickers. UPXI, I was in that trade, and then MCV.
What is this one?
Okay, that is a Solana treasury company. Upexi, I don't know what it was originally.
It was something else, like I'm just making this up, but like a biotech or pizza company or something. But now let's add some Sui or Solana to our balance sheet.
It's a Solana treasury. Yeah, yeah, exactly. And I think really what it is it's sort of a leverage bet on Solana. Like I think, yeah, again, I have money in my the answer is I have money in my Tasty Trade account. I already have a bunch of Solana. I just wanted to make a trade on this kind of leverage bet on Sol.
Okay.
And I
mean,
thought it was,
when I look at that, right, it makes sense too. You've got something that's $5, now it's $8 or was $8. Sure, Solana's up 22%, but if you put the same amount of money into this, you're up more.
Right. That's the answer. There's some options on it. The options are liquid. Maybe there's some plays there. I won't get into that. Little bit, maybe there are some trades there. We might dig into it. The volatility is pretty rich, but there's not a lot of volume on some of these. So some open interest though, obviously. So there's some plays there.
Yeah.
And that's kind of what, I mean, it's just
penny wide at the money here.
Yeah.
Or maybe not so much at the money, but your 10 strike, well, yeah, a little bit tighter on the calls. That said, okay, I didn't realize there were options on these.
Yeah. So those are, I mean, that's the reason, right? Like it's sort of a leverage bet on Solana. You get a little bit more, I guess you could take some advantage of some of the high premiums in the options. And then I think I bought it a couple days ago. It was $5-6. It opened today at what, 8, close to 9, 8:30 it opened, 8:50.
Good trade, my friend.
Yeah, it was a really quick trade. There was no other reason other than that was the next one. People were paying attention to the Bitmines, the ETH ones. UPXI was the next one, Solana.
Okay, I like it. I mean, in a world where you really, I mean, you don't have Solana ETFs, at least not U.S. listed Solana ETFs. You don't have options or really any way to access derivatives on these. This is a proxy for that.
Right.
You have, in some cases, depending on what happens here, you've got relatively liquid option markets, not super liquid, but not extremely illiquid either. You could probably get something done in there, depending on the size you're trying to work. This is a way to get that exposure. You mentioned Sui as another potential opportunity that you could get some exposure or leverage exposure through a treasury company. What's the ticker symbol that you're looking at there?
MCVT. Same idea.
Oh, these are the guys that are coming on the show on Monday, right?
Yes. We'll have the chief investment officer of MCVT on the show on Monday. We'll do a live interview with him, and I would love to dig into the strategy here. But basically, this came out a couple weeks ago. I think it might have been last week even. They raised $450 million through this Mill City Ventures vehicle to buy SUI, the token SUI. We offer it on the platform. And again, same idea. Look at that candle. Or what is it? Candle. I bought it a couple days ago and sold it at the open this morning. So it was a really quick short-term trade. Doesn't have options on it yet. And I think there's some opportunity there. Now it's going to get crazy, right? I've heard of a couple others. I don't remember the tickers. I'll get the tickers to you maybe next show. They're buying Bonk and Doge and like meme coins. So again, we're getting to a point where this is a little bit, I think, ridiculous. But these two being ones that I think are decent rotations from the ETH.
Yeah, I'm going to keep an eye on this, and we'll add these to our crypto watch list. We've got all of the underlying cryptocurrency tokens, as well as some of the ETFs that have options, some of the kind of proxy plays, the crypto companies, the miners, and now there's an abundance, seemingly, of these treasury companies. Does this one have options?
No, it doesn't.
Okay.
Does not have options yet. Maybe we could ask the investment officer about that. I don't know.
Yeah, I think that'll be a great conversation. If anyone wants to tune in on Monday, like Dan mentioned, CIO of Mill City Ventures and their SWE treasury strategy.
Yeah, I think that you have to be very. I think you have to pay attention to these, but there's opportunities here. I think because look, you could have got it beginning of August, 10 days ago, down at $4. It traded up to what, $8.50? Yeah, it traded up to $8.50 this morning. It's pretty good return for.
And if you like your volatility, well, you've got your volatility here. We'll keep an eye on this one as well. I might have to do something in here if we get a little bit of a pullback. I like the idea. Dan, did you trade bullish today?
I have not traded bullish. I saw the headlines. I'm typically not a buyer of IPOs, which I guess, didn't work out with Circle. I probably should have just bought it, but
I'm trying to get the chart to give us an appropriate view. I mean, we've got 1 day of trading activity, traded up to 120-ish, 116, we'll call it 115 or so, and down to 70. Ouch. I'm looking at the right thing, right? Yeah.
Yeah.
Okay. Not sure what happened here, but hell of a move out of the gates.
Yeah, I don't necessarily trade IPOs. I feel like you're the one being dumped. I mean, they're kind of dumping on the market.
Yeah, I mean, in most cases, there is going to be a lockup period, so a lot of insiders aren't going to be able to sell for, let's say, 90 days or more or so. But yeah, I haven't. Just curious if this was on your radar or not, given that it was up quite a bit earlier, but has come down a little here.
I saw it. I saw the headlines, but it's kind of going crazy. All these companies are IPOing. I think Kraken will IPO at some point too. How about you? Did you trade this?
No, I haven't done anything in here though. Since we had Greg on the show a couple of weeks ago, I've kept my eye on. Let me change the chart around. Apologies. Had an eye on Circle. That was one that was hot out of the gate, but has consolidated a little bit here around 150. I saw price targets come out from some analysts around 250. Whether you care about that or not, some people do pay attention to that, and it gets a little bit of excitement. Speaking of price targets, Standard Chartered came out with a $7,500 end of year ETH price. ETH at about 47 today. What do you make of that?
I think it's possible. I made an $8,000 call on Liz and Jenny earlier this week, so hopefully it's
conservative.
It's conservative, yeah. I think price calls are fun. They make headlines, but I think Standard Charter's kind of always come out with.
They've been bullish.
Yeah, they've been bullish.
And I guess to their credit, they've been right. I think if I recall, a lot of these investment banks and some of the analysts have come out with price targets for Bitcoin end of 2025 closer to 200, which if we keep trading the way that we are, we might get there. We've talked about at times 150 kind of being a level that I think is realistic, but we've got to got to break to new highs first. That said, Dan, to kind of, I guess, come back to reality, at least in the short term, with what's realistic or probabilistic, more so. Let's jump back over to the slides here. And let's take a look at our volatility dashboard just to give everyone a sense of, I suppose you could call it realistic expectations. So if you're not familiar with the show, not familiar with what we look at or how we look at it here, these are also the dashboards that we put into the newsletters twice a week. But we have our volatility, implied volatility ranks for Bitcoin and ETH, which I think most people on tastylive are familiar with. Definitely seeing a pickup in ETH that coincides with the higher prices. This is what you want to see. You want to see that expansion in vol on the upside. There's typically that positive correlation between price and volatility, so that's an encouraging sign. In the same way that you want to see a lot of volume behind the move, right? Supports the up move. That said, these are the 1 week expected moves that we calculate based on the spot price and the implied volatility for Bitcoin and ETH. For some of the tokens that we don't track in implied volatility, we just use 30-day realized as a proxy. It's better than nothing. We are seeing an increase in realized volatility on a 30-day annualized basis for all of the tokens that we're tracking, which is, again, no surprise given the price action. But when you think about ETH specifically, what's realistic? If we do continue to stair step higher, you get to 6, 7, 8, 10, 100,000. Just kidding. But let's say that you're right on your price target. It's 8,000. I think it would be healthy to see a little bit of a pullback there, right? Maybe a bit rich at this level, given how quickly we've moved off of 4. So if you do pull back, what's the option market pricing in within one standard deviation, meaning 63% essentially probability? And this is not static. It's going to change based on changes in spot and vol. But right now, we've got a one standard deviation move of about 42.50 to the downside and 5,200, we'll call it, on the upside. So $473 move or so, round that up or down as you'd like. These are not perfect or exact targets. But if you were to pull back, it wouldn't be unreasonable at all to think that we might come back down to 4,200. And that could happen very quickly. If it does, I'm a buyer. How do you think about it?
Yeah, I mean, I've traded these markets for a number of years now. Like as quickly as it goes up, we get these pullbacks, and then they're usually V-shaped recoveries. So like I am adding probably below 4,500, 4,200. I think like I'm not adding any more at these levels, but I'm waiting for a little bit of a pullback. I don't think that's out of the question. I don't even think like a flash crash to 4K is out of the question. That just happens with the way the market structure is for crypto. But usually in these environments with the way things are trending, we get kind of that quick V-shaped recovery. So yeah, I mean, no reason to not have some limit orders in below 4,200, below this range if you want to kind of catch these moves down. But I don't think it's a straight line up. So I do look for a little bit of either consolidation or pullback, and I don't think that's out of the question to see toward the end of this month. But I think we're still in a positive environment. I think all signs are pointing to this trend to continue. And like I said, we're rotating into ETH. Altcoin season might be next. You want to be paying attention to that. And I think a lot of people were waiting for this. So this is where it gets fun.
Are you taking? Oh, hell yeah, it's fun now, right? And we can say that, and we can. I think we take a little bit of a victory lap because we've been here through the darkest of days, right? And for proof of that, you can go back and watch me on the show with Tom and Tony in 2023 if you want. Hit the archives. So we're having fun, of course, but we've seen the darkness in a sense. Are you selling any on the way up? I've been taking some off the table on the follow page. You can see the timestamps. You can see the prices there. We'll jump over to that. So I am not perfect by any means, but if you want to get a sense as to kind of what we're doing or how I'm thinking about different things at different times, maybe all hours of the day, click on me and you can see it's just crypto, and kind of do it in chunks where, we're going to buy ETH. We're going to sell a little bit of ETH at the top. I think what people can struggle with at times is buying it back at a higher price than where you sold your last tranche or chunk or whatever you want to call it. That to me is just trading the market that you're within. I don't think there's an environment where, well, I bought ETH at 2,500, I sold it at 3,500, and it's at 4,500. I've got to wait for it to go all the way back down to 3,500. I don't think so. In some cases, right, you've reached escape velocity. You're not going to get that. You might on multi-year time frames, but there's no real indication today that you're going to go from 120 to 75 in Bitcoin. Right. I suppose anything is possible, but you have to trade kind of those new ranges, obviously. So back to my question: are you taking any off the table at or near these levels?
It's a good question because it's something I've struggled with throughout my trading journey in these markets. I've always been able to get in at low prices, and then I've struggled to push the sell button. So my new rule is anytime it hits an all-time high or close, 122, 123 on Bitcoin, let's say, I sell a little bit. I have a core position that I've held for a while in Bitcoin, ETH, the majors. But anytime we get to an all-time high, I sell a little bit. That's been my rule, and that's what I followed this time. I know you have more sophisticated trading signals, technicals that you can follow, which I'm getting a little bit into myself, just to kind of like
tarot cards and a crystal ball.
Yeah, but
it's some magic dust.
But on the short, it works as like a rule, an emotion, kind of like an emotional rule, right? Like, all right,
you need some rules.
It's not something that you would follow to hold for a long time, but if you're buying a year ago ETH, or let's even say April, you're buying 4 months ago in April. I mean, ETH hits 4,800, gets close to an all-time high. Like, why are you not selling a little bit? I think that's just kind of something I learned. So yes, I am taking a little bit of profit, but I'm not exiting. Like, I'm not going to all cash, right? There's nothing in the market currently that tells me we need to be in all cash. I think when the macro environment changes, I think when we see some of the air get out of this like AI tech stock kind of craze, maybe you would. One of the signs of an overvalued market is all these IPOs, right? Circle going public, Bullish going public. We have all these treasury companies. Everybody's copying each other. Like, that obviously gets exhausted after some while, and you have to be aware of that. But
it's not today.
There's no and there's no like flatten your position immediately. Like, I genuinely think just being in these markets, it gets a lot crazier.
Right. I think that's a good point, right? You need to take some off the table. You have to have a rules-based approach, whether it's I'm going to do 25% or have a price target, or you just simply have a dollar value in your mind. My net lick gets to X amount. I can go and take this vacation or do this thing or whatever it might be. I think it's certainly prudent to take some off the table, because you're going to see on Twitter this story, whether it's true or not, of somebody that, I held Bitcoin at 5,000 and rode it to 125,000 and had a gazillion of them. And this person made, hundreds of millions of dollars. Or we've seen whales that haven't touched the position that moved $1 billion of Bitcoin over the last month or so, right? So there are those stories out there. But there's 99 other stories of somebody that bought it at that price, rode it all the way to the very top, and then rode it all the way back down to that same price or maybe slightly above because the market finds a higher low over a longer term time period, right? Yep. And so I think you have to have an approach. I wrote about this, and this is the last time I'll mention the newsletter, but hit the link in the chat. Go sign up for the Tasty Crypto newsletter at tastycrypto.com. Wrote about this morning. And the simple point is this: stick to the mission. The mission in crypto is to make some money. This is a vehicle for making money. It's extremely volatile. It can be a lot of fun. The more volatile it is, I think the more active you should be. A good example of that is probably Aave. I'm assuming higher now. Current price, $329. We bought some at $291, dumped some at $317. I treat some of this stuff like a volatile stock. You can't trade through the rear view. It's obviously higher at 329. That said, the mission is not to try and perfectly time the market. It is to make some money, take some off the table. You have a little that you got to put aside for tax purposes, I guess, if you're in the U.S. and aren't in a tax haven. But you can enter back in on dips, have a little bit of patience, but stick to the mission. The mission is to make some money, not to perfectly time the market. That said, Dan, I think that's going to do it for our show. I'll give you the last word, though.
Plan your trade, trade your plan.
Beautifully said. We're going to be back next Monday with the CIO of Mill City Ventures, talking about SUI, talking about the strategy, talking crypto markets. But until then, I'm Ryan.
I'm Dan.
Peace.